Hey guys and gals, it's Charlie. I know, I need a more interesting background. I promise next time I'll come up with something, okay? But in the meantime, let's talk about two interesting ways that you may not have considered that you can invest in real estate. If you didn't think you had equity, you actually might, right? So let's say an investment opportunity comes along, you don't have that kind of cash right now to throw down on it. Well, there's two different things you could do. One interesting way is to tap into retirement monies. Now, why would you want to do this? Why would you want to tap into an IRA to invest in real estate? Well, you can still do it tax-free, just like you are. And you can diversify your portfolio outside of just stocks. So here's how that works. You open what's called a self-directed IRA, and you just do a one-for-one exchange, trading that money over into the self-directed IRA. Then that company can invest your money in things outside of stocks. Basically opens the aperture of things you can invest in. You can invest in businesses, um, and then all sorts of different real estate ventures. I'm sure there's other things out there. I haven't really thought about it. Maybe Bitcoin? I don't know. But with a self-directed IRA, it allows you, if an investment opportunity came along, like an apartment syndication that you really wanted to get into, you could transfer that money across. It would all stay still. It's the same tax benefits, and now invest it into that deal. Now, here's the thing. Just like your current Roth or traditional IRA or 401k, you can't touch that money. So if it's an apartment syndication that pays out monthly or quarterly and has a big return at the end of the 5 or 7 year window, whatever it is, you can't actually take that money and pocket it. It goes back into the self-directed IRA, it goes back into your retirement monies and grows that nest egg, right? Just like your regular IRA, but now you can diversify beyond just stocks and bonds. Now, right now, it's 28 March. The market has dipped because of COVID. I personally am mostly invested in high-risk stock kind of stuff. S&P 500, total stock market, 2050 funds, that kind of stuff. So I would not personally move my money or trade my money into something else because I want to wait for the market to recover, right? I still own the same number of shares. That hasn't changed. My account may look smaller, but as soon as the economy recovers to pre-dip rates, to pre-dip status, then I'll have the same amount of money. In fact, I'll have more because I'm doing multiple contributions. I'm contributing every month like clockwork, right? That is the way to do it because right now I'm getting stocks at a discount. That's how I see it because the stock market is a very, very long-term game, okay? Sorry, off my soapbox, I just wanted to, just a little tidbit for people. The other creative way to find equity to invest in a deal is in a home. It might be the home you live in. It might be a home you lived in before, but you turned into a rental. You could do that in two ways. You can refinance that property if it's worth more or you've paid a lot of it off, which then means you can grab that money tax-free and do whatever you want with it. Or you can get what's called a home equity line of credit, which means you basically borrow against the equity in your home. And that's usually at a rate lower than a mortgage. And right now, with this whole COVID thing, the Fed dropped the Federal Reserve rate really low. So that means I'd be interested in seeing what you could get. You could probably get a pretty low interest HELOC right now. Now you're asking, why would I want to take on interest to then invest to earn interest? Here's why, right? If I told you you could borrow money at 2% but invest it at 10%, is that something you would do? I would, right? So you have to kind of think about it. If an apartment syndication deal came along and your HELOC lender would let you borrow $50K against your home for 2.5%, let's say, and you expect the 5 to 7 year end return on that investment to be about 15% a year, would you take that deal? I'd venture to say, yeah, I would definitely jump into that one. Now, it's a risk-reward thing. If you were going to get a HELOC at, say, 5%, which would be terrible, and the investment deal you're looking at is only going to net 8%, that 3% spreads, for me, that's probably not enough for me to do that, to make that leap. But it's just something to consider. Another thing you might not have thought of when you're looking at investing in a deal and growing your passive income. So just want to throw that out there. Now, with that one, you can pocket all the income from that, right? Unlike the IRA that's kind of locked away till you retire, age 60 or so or later. This one you get to have monthly. Anyway, that's just some thoughts for today. If you guys ever want to talk about investing, know anybody who's interested, um, talk about life, whatever. As my wife knows, I can talk about real estate all day, any day for an indefinite amount of time. So, just hit me up. I love chatting about it. Anyway, hope you guys are staying safe, COVID free. Be well. We'll see you.